require a calculator. So welcome back to another session. And last week we completed topic number 1. And this week we are doing topic number 2, and that is recording transactions. In accounting practices, we as accountant, we encounter so many transactions in one particular day. And where to post them is of much importance than posting itself. Because when it comes to accountability, it matters a lot where the transaction is than what the transaction represents. Because if a transaction is good but placed in wrong account, then it lacks sense. So in this session, we are going to look at several documents that as accountant we encounter, and we also look at how to post transactions in those documents. Now, there are some of the sources or some of the documents that we normally have which provide us with information. We say that we have quotation, purchases order, statement of account, remittance advice, receipts, paid cash voucher, sell invoice, purchases invoice, credit note, debit note, and finally bank statement. This is where information is stored, or it portrays what kind of transaction that has taken place. And in this sense, we are saying that the details of financial transaction are usually described on various documents received. And under this document, they provide us with the input data or the raw data, which finally it will be communicated to third parties for them to interpret how the business is doing. Now, when it comes to quotation, a quotation is used to let potential customer knows the cost of goods or services before they decide to purchase them. If you are bidding for a tender, you will be asked for a quotation, just a list of prices of goods that you store, so that they can decide whether you are going to win the tender or not. So basically, quotations, they give much about the items that you are selling in respect to their prices. And what should be included in a quotation? There are a number of items that should be included and considered when prepared in a quotation. Basically, first of all, you need a quotation should include the price, because you need your customer to buy. And as we look in other courses, the prices determine the demand. So in a quotation, you have to indicate the price that you have decided to change for the services or good you sold or good that you have. Basically, you also indicate whether your goods are VAT inclusive or VAT exclusive. VAT inclusive means that the prices already has VAT part component in it, and VAT exclusive means that you are selling were exempt VAT. So after quotation, you'll have what we call purchases order. And in this case, we are saying that a purchase order is a commercial document used by a buyer or a seller indicating the types of quantity and agreed price for the product and services to the seller that the seller will provide to the buyer. So you may not have time to write all this because I have shared this document, and that's why you see I'm picking the major, the most important part that we need to learn as we move on to the calculations part. This course is basically more about calculations, but although this theory is also very important for you to understand the environment you operate in as an accountant. So we are saying that a purchase order is a commercial document used by a buyer to a seller indicating types, quantity, and agreed price for product or services the seller will provide to the buyer. So companies use purchase order for several reasons. And we're saying the first reason is the purchase order allow buyers to clearly and explicitly communicate their intentions to the sellers. Second point, we are saying that sellers are protected in case the buyer refuses to pay for goods or services. In accounting practices, before we offer you a service, we normally have what we call letter of engagement, such that at the end, if you offer that services and you fail to pay, we are able to account or to tell you, you see, you signed this document, so the services we did, then you have to pay because you had agreed that. So in this case, we're saying that a purchase order is also like a binding contract between the seller and the buyer. And the last point here, you're saying that commercial lenders or financial institution may provide financial assistance on the basis of purchase order because they already believe that you have agreed on the services. Okay, then I want to avoid the statement of account and move on to, I also want to avoid the remittance of account. I'm moving on to the most important part as accountants, the receipts. Receipts are interacted with in day-to-day life as accountant in accounting practices. We see that a receipt is raised by the firm and used to customers or debtors when they make payment in the form of cash or check. Of course, this is all of us, we have interacted with this before, that it is just a confirmation that I've received payment, so you are issued with a receipt. And in this case, with the current or currency, these receipts will be issued through eTIMS that will show that you have. And when you come to eTIMS, this receipt will be called invoices. They are just confirming that you have made the payment, and in this case, you are officially owning the property. Now, there is something called petty cash voucher, and in any organization, there's always a need to buy small items. You're in a company, you need to buy tea, you need to buy sugar, you need to buy pencils, you need to buy rubbers, depending on the organization status or the organization setup. Now, a petty cash voucher basically will be used with these expenses that don't require you to write a check, don't require you a lot of complex transactions. So you require to have a petty cash voucher. So you're saying that a petty cash is a small amount of discretionary funds in the form of cash used for expenditure where it is not sensible to make any disbursements by check because of the inconveniences and the cost of writing, signing, and then cashing the check. For instance, if you're in a company and the CEO normally reads a newspaper every day, so you don't require to write a check so that you can buy a newspaper. So accountants will always interact with the petty cash. We are going to see later petty cash book, but in this case, we're talking about petty cash voucher. These are generally used to buy small item. So we are saying that a petty cash voucher is usually a small form that is used to document disbursement or payment from a petty cash fund. A petty cash voucher are also referred to as petty cash receipts and can be purchased from office supply stores. So when you're buying items that are of small value, you don't necessarily need to write a check, then you issue a petty cash voucher. Now, the other thing you're seeing there is called sell invoice. Sell, as the name pronounced, and I had also mentioned this currently when we are running expenses through eTIMS, we are issuing sell invoice. And fortunately, next year, you'll not be able to account for expenses which have not run through eTIMS. Yeah. So a sell invoice is a financial accounting. No, a sell invoice in financial accounting is a tool that a company uses to communicate to clients about the sum that are due in exchange for goods that have been sold. An invoice is like a demand of payment, or I have offered this service, I'm giving you an invoice so that you make arrangement and pay me. Once you pay me, I'm going to write for you a receipt to show that you have completed the transaction. So a sale invoice should include the information about which items the customer has purchased, the quantities he has bought, discount he has received, and the total amount he owes. So when you are, of course, when you're drafting an sale invoice, most of them in a commercial setup, you'll have them printed. We are saying that sale invoice contain the following. There should be name and address of the farm, name and address of the buying farm, date of making the invoice, invoice number, amount due, description of goods, terms of sale, and many other. In fact, if you read the Income Tax Act, it has it's not even Income Tax. It is Tax Procedure Act. That is the one that is basically talking about the tax invoice. A tax invoice will have certain characteristics, and this what I've listed here is some of them. That these features should appear in any sales invoice for it to be valid. Now, when you're selling, you issue a sale invoice. When you're purchasing, you also get a sale invoice. So you're saying that a purchase invoice, when you're purchasing, you get a purchase invoice. A purchase invoice is raised by the creditor and sent to the firm when the firm makes a credit purchase. Sale invoice, the seller is one issuing to the buyer. Purchases invoice is the buyer issuing to, but on this case is when the transaction were made on credit. A purchase invoice is raised by the creditor and sent to the firm when the firm makes credit purchases. And then there's some features that should appear. These two, the terminologies I'm trying to explain here, they sometimes confuse accountants, especially when you are told, oh, guys, can you generate a credit note? Hey, can you do this? Then someone starts asking, what is a credit note? What is a purchase? What is a selling? Can you issue a selling invoice? Don't be surprised someone in accounting practice and you ask him, what is an invoice? Someone will say an invoice is a proof of payment. No, when you approve of payment is receipts. An invoice is a demand of payment. I've offered you a service. I issue an invoice. Does not mean that you have paid. I'm issuing you an invoice so that you make arrangement and pay me. Once you pay me, I issue with a receipt. So that is it. Now, the next thing is on a credit note. A credit note. I had mentioned that you can be told to issue a credit note. Then what is this credit note? So you're saying that a credit note is raised by the firm and issued to the debtor when the debtor returns some goods back to the firm. Here, you make sales, and the buyer returns some of those items to you. In your records, you have to reduce your amount of sales. The good you get, we call them return inwards. But when you're issuing a document to prove that you're going to issue a credit note, so we're saying a credit note is going to correct sales. So a credit note is raised by the firm and issued to the debtor when the debtor returns some goods back to the firm. I sold goods to you. Initially, I issued you with a sale invoice. You return some goods to me, I'll issue you the credit note. A credit note is going to correct the sales. It's going to reduce the sales. So when you issue a credit note, you are reducing your sales, or you are proving that your sales have reduced because some goods have returned to you. The opposite of a credit note is a debit note. or debtor's note. We are saying this is raised by a creditor and issued to the firm when the firm returns some goods to the creditor. You bought the goods on credit, so the creditor is the one issuing a debit note. This is raised by the creditor and issued to the firm when the firm returns some goods to the creditor. When I hope this is very clear, that the creditor is the one that issuing the debtor's invoice or the debtor's debit note, but the credit note is issued by the firm is issued by the firm to the buyer to show that the sales have reduced. Now, of course, in our transactions in day-to-day life, we have come across bank statements. When you transact with the banks, at the end of the month, you can ask for them to give your bank statements as a proof of transactions that have taken place in your account. So here we are saying that a bank statement or account statement is a summary of financial transactions which have occurred over a given period on a bank account held by a person or a business with financial institutions. And this bank statement can be issued in form of paper statement, or it can also be electronically. That means you get a electronic statement or a paper statement. Now, at that point, before I proceed to another area, any question concerning some of those terminologies that you have discussed above? Debit note, credit note, bank statements, and the rest. Can I hear someone on the chat? In your free time, I may not, in your free time, you're going to revisit the area and make up short notes that you are going to remember very quick. You can see even me when I'm explaining this, I don't have to pick everything. I'm picking the most important point that you'll have to remember easily during your revision. Anyone with a question before we move on? I'm seeing a message here. Am I seeing? Oh, we are good. I'm seeing the message confirming that the information I've said is understood. Now, I want you, as we move on, I hope you have yourself a calculator, because at the end of this, we shall do some basic computations. Books of original entry. Books of original entry, we are referring to where the transactions are recorded first before you post them to relevant ledgers. Like, you can have a book of entry, a cash book. You record transaction in cash book, then from cash book, you post them to their respective accounts. So when talking about the books of original entry, you're referring to an accounting record that is used to record the different types of transaction in a chronological order or date order. The reason for being called the books of original entry is that it is the first place that a business transaction are formally recorded before you now transfer them to other places. Example of books of original entry, we have in what we call the sales journal. A sales journal is a special journal where credit sales to customers are recorded. Remember, a sales journal, we are recording credit sales only. Cash sales, you record them in cash book because it's money being received. Not even you issue a receipt for cash sales. Yeah, and you can record them in sales account. Purchases journal, the same thing. The purchases journal is a special journal where credit purchases from customers are recorded. This is the book, or is this the place, the first place you record credit sales and credit purchases. Return inwards, when you make sales and goods are returned, you record them in return inwards journal. Return outwards is for purchases. You see, return inwards is a special journal that is used to record returns from debtors. When you make sales on credit, you have debtors. When these debtors return goods to you, they are called return inwards. They are reducing your sales. When you make purchases, you are the one who is doing that, and you are purchasing them on credit. When you return those goods, you have what we call return outwards. Return outward is for purchases. Return inward is for sales. So up that point, you have understood those few books of original entry. The other one I had mentioned about a cash book. A cash book is used to record the receipts and payment of money by a business in the form of cash or through the business bank account. As we move on in this course, you are going to interact with so many of them. You're going to look at cash book, 2-column cash book, 3-column cash book, and they are the way you can work and populate your data. We also have a petty cash book. I had mentioned when we were talking about petty cash voucher, you can have a petty cash book. This is as the name. This is just a fancy name that describes a special fund that is set up and used for minor and anticipated cash expenses, where a check can't be written or the amount is too small that you don't need to write a check. And I explain in a business setup, any organization that lack petty cash book or lack petty cash, it is not serious. There are things that come as emergency and you don't necessarily need to go to bank. You're in a company and you need transport. Just move from one place to another. You don't need to write a check and the transport is 200 or 100. Yeah. So basically, in every organization, there's always a petty cash book, unless the organization is not well structured. General ledger, we have general journal. The general journal takes to record the events, debit and credit, that is characterized by the fact that all the records it contains are in sequential chronological order. The general journal is used to record unusual or infrequent types of transaction. When you record a transaction in a general ledger, is a transaction that cannot be recorded in all the other items I have mentioned above. Yeah, like you want to record depreciation entries. Yeah, you want to make adjustment. So you cannot have depreciation journal. You'll record that transaction in a general journal. So basically, those are the original books of entry. In another accounting terms, we call them prime books. They are prime books, the books of original entry. These are books that you record the transaction initially before you post them to their relevant ledgers. It's like the mother of all other transactions. They are recorded here. Now, we want to move on to how to record transactions. And before I move there, anyone with an issue on the books of original entry? Anyone who need clarification on prime books? And you also need to comment so that I can also believe that you see should be a two-way. Fatima, kindly make a comment to know that we are together. Good. I'm glad to see that. Now, we want now to see how do we record this? Yeah, how do we record this? I will not read a lot on this. I will move straight to sales journal. A sales journal book record details of all credit sales by the business. The details are obtained from a copy of sales invoice. This is how a sales journal book look. You are going to write the date. Basically, if you are a business person, you are missing a sales journal, because this is very, very important, especially for your record purposes when it comes to credit sales. So it has a lot of features. It only has the date, details. Folio is a reference you put so that you can know where are you posting in the ledger. Like if you have sales account, you are going to give that folio as a reference that I'm recording this transaction in a sales journal, but there is another account which refer to the same transaction, so that anyone following up will be able to know that this transaction is emanating from sales journal. So the sales journal look like this, and I want to see how to post these items. Can you look at the items listed here? You are to enter up the sales journal from the following details. We have credit sales to J. Omondi, 1870. Credit sales to G. Achengo, 1660. Credit sales to V. Charles. Credit sales to J. Joroge. Credit sales to F. Mwangi. Credit sales to U. Akech. All these one are credit sales. So there is nothing I'm going to sort out. There is no cash sale. So all of them will appear in your sales journal. So you list them, all the clients. Unfortunately, some data here went missing, but I should be able to, like this one, Jia Cheng 1660. There should be 1660 here. When I was editing this one, I forgot that part. Then there is V Charles, there is 120, J Joroge 550, Mwangi 2890, your cage 660, all of them should appear here. They're just displaying information that this transaction was sold on credit. That's why they appear in a sales journal. We move quick and we move to purchases journal, the same information. This one, there's no difference with what you have said above there. All transactions, as long as they were made on credit, if all the purchases were made on credit, then the items will appear, all of them will appear as I've posted there. All the items, because all of them are on credit. So each and every item will be posted against their price. Sales returns or return inwards, I mentioned this one, they are used to correct sales. So when goods are returned to the business, then they are recorded in the sales returns or return inwards book. We are seeing that it's also called return inward day book. It records all the credit notes raised by the firm. We see that credit notes are issued to reduce sales and sent to customer during the particular financial transactions. The details in the details here will change depending with what journal you are dealing with. Like in this case, here we are going to have credit note number, description, folio number, which are missing in the previous journal. If you look at this one, we don't have credit number here. Now, purchases return, we said purchases return are used. The difference between sales returns and purchases return is that when you make sales, the sales are returned to your business, you record them in the sales returns or return inwards. When you purchase goods and you yourself, you return those goods, then you record them in purchases return or return outwards. All these terminologies are referring to the same thing. And the population of the items will appear as indicated there. I mentioned to you that you need to have a book, a calculator, and a pen, and I want you to attempt this question. I don't know how long I should give you. You're told that you are to enter the following items in the books of 2021: credit purchases, credit sales, credit purchases, credit sales, return outwards. I would like to know which items are in each category. So meaning that here you are not opening only one account. You're going to open sales journal, you're going to open purchases journal, return inwards journal, and purchases return journal. I'll give you 10 minutes. And it is 8:49. By 9, you should have attempted and given me some figures. I know I shared this document with you. Please don't copy. Just work it independently and confirm that you have understood. You have 5 minutes. Yes, I can see. Ben has posted his total credit sales. Fatima, what do you have as your credit sales? Let's see. Uh-huh. Purchases, that 292 as well. Mm-hmm. Return inwards, 97. Return outwards, 70. Oh, Fatima is saying don't have a calculator for today. Okay. Please, next session on accounting and quantitative analysis, please come with the calculator. So, Ben, you can see. Ben, that 292, what did you miss? Because it appears Let's start here. Credit purchases. This one will go to purchases journal. All these items will appear in purchases journal. Credit sales. All these items will appear in the sales journal. Like in this case, you have Ken S11 has 510, Eros 246, and Ton shillings 356. They are the first three items here. Yeah. Credit purchases, this one will go to purchases journal. Credit sales, you have 307 is the next item you have in here. And then you have 250, the next item we have here. And ton 185, the next item we have here. Return inwards will go to return inwards journal. No, return outwards will go to return outwards journal. Return inwards will go to return inwards journal. Credit sales will go to sales journal. We have 188. The next item we have here, 310. The next item we have here, and 420. Yeah. So basically, the remaining three, they are no credit. I'm seeing a message. Let me see. Okay. Ben is trying to correct himself. That's all right, Ben. That's all right. This we say this one is for purposes of learning. Remember, I also need to tell you that speed when it comes to financial accounting is very key, and accuracy. Speed and accuracy. In this case, Ben, that's all right. Maybe you typed 3 instead of 2. Now, the remaining 3, we have purchases journal. These were the figures. Then return inwards, 97. Ben, you okay? What did you give me as purchases journal? Let me see. Did you get that 292? Ben, what did you get as purchases journal? Correct. That 292, then 97. The other one you got 70. Correct. So Ben, basically that area you got everything. You got everything in that particular part. Now, Fatima has said that she did not carry calculator for today, so I will not proceed to cash book because cash book entries will require some calculations. We require to prepare a cash book, and I will give you time for that. So today I think we can stop here for this lesson. You go and revisit on how to prepare those journals, and also read more about the prime books and basically the information surrounding transactions in accounting. Unless there's a question, I beg to stop here. Any question? Fatima, how was the lesson? Have you understood something? I'm waiting for the feedback before I wind up. So Ben, that your response, that's correct. Fatima, welcome you to this session. And I'm expecting that as we move on, I'm determined in the next 2 months, by November, we should be done, not even November, mid-September, mid-October, we should be done with the syllabus. Was good, sir. Thank you. Okay. Having gotten those positive responses, I will stop this lesson here. We meet in our next session. Goodbye for now.